This is the Real Estate Shop, where each episode will bring you a top industry expert to share their current programs or projects that are making an impact in our communities today. Be sure to check us out on Spotify and Apple Podcasts. Welcome, Chad, to the Real Estate Shop. Appreciate you coming on to give us an update on the debt market from the agency side of affordable housing. Before we jump in, I just want to kind of do some context for the younger kids that are out there that are listening. You know, Chad and I, we actually hooked up at a conference, man. I want to say it was 2018 in Miami. And, you know, the moral of the story is, you know, you make that one meeting, you stay in touch, you know, with the brother over the years. You know, we've been trying to do some deals. You know, podcast wasn't even on the table. So now, you know, Kirby and I have a podcast, and lo and behold, bam, here's Chad. So, you know, word to the wise, you know, when you work these connections, man, just stay in touch, because you never know where it's going to take you to. But so just to get started, Chad, you know, how did you get started in the industry, and what was your background?
Yeah, no, I appreciate it, Steve. Thanks for having me. And yeah, man, you kind of took me through a little walk down memory lane. Yeah, I remember that conference. It was actually, I think, at the Pelican, at the restaurant on the water there. So glad we connected. But yeah, no. So look, I got my start in the business back in 2011. You know, I could tell people. I mean, it really, you know, I think it really took a downturn, right? For an industry that had been kind of red hot, running for so long, right, through the, you know, early mid 2000s, kind of post the dot-com bubble, and then obviously running up to, you know, the Great Recession of '08. You know, I was in New York. I had finished up school at Columbia, and you know, was working down on Wall Street and kind of in the equity research space. And you know, had a close friend and fraternity brother who knew someone at what was, you know, then my former shop, Centerline Capital Group. And you know, I've been kind of looking for some ways to get into the real estate and structural real estate finance world, in particular, kind of the multifamily space. And Centerline happened to be an agency lender, and you know, got connected with someone in HR who happened to actually be a Black woman, and so she was very helpful and instrumental in kind of pushing my resume, you know, internally, and pushing for me to, you know, get an opportunity just to interview. And I think roughly about 7 or 8 interviews later, I actually ended up securing a position. So started in New York as an analyst, cut my teeth in the agency world, and you know, just kind of worked my way up the food chain. You know, saw that company go through several iterations via acquisitions, and my travels took me from New York to coming down to Miami to help launch an office for you know, the next kind of parent firm that had owned the company, and you know, stayed with them until recently, until last year, where I made a move and now sit at my current firm at M&T Realty Capital Corp. And I run Florida and kind of Southeast expansion for the agency and mortgage banking business.
Nice. So tell us, like, exactly what type of work do you do? I know for the benefit of our folks, of course, I know that you're in the debt space, heavily involved with the agency loans, but kind of walk us through, you know, exactly what you do on a day-to-day basis, how you find clients and that type of stuff.
Yeah. So on the most basic level, my role is like you said, to originate debt for the agencies, and the agencies are Fannie, Freddie, and HUD. So what that means is simply I am, you know, going out and sourcing potential deals where we can provide the senior loan, mainly in the multifamily space, and that is, you know, across affordable housing market rate, and then the agencies also play in, you know, the senior housing space, manufactured housing, student housing, et cetera. But yeah, essentially my job is to develop those relationships, whether they be, folks who've kind of gotten in the business and you're going a little bit and, may not be the largest borrower to, the high net worth individuals, all the way up to the institutions who on a day-to-day develop, own, operate, multifamily across the country.
Got it. And just to show you how small the world is, Kirby, jump in. I know you've had your own relationship with Chad, being the market study guy. Kind of let everybody know how you and Chad hooked up as well, just to give folks a broader sense of how close and tight knit this industry really is.
I had Chad at a conference as well. I think it was NHNRA in Florida at the Breakers, and we exchanged emails prior to that. We talked about some deals, but never met in person. So, and Chad lives in Miami, and so I said, "Hey, would you happen to be going to this conference?" And he said, "Yeah, I'll be there. I got a lot of stuff going on, but I'll pop in, and I got some meetings lined up already at the conference. So, let's do it." So, we both met at the event, and I had a chance to connect, and we still talk probably on a regular basis now about deal flow and things he's seeing in the market and things I'm seeing. So it's been amazing to see how both of us have kind of grown since that conference, and we talk about stuff beyond business. Like we talk about managing a household. Chad has three kids. I've got a young daughter and working on a second now. So it's grown beyond just a business. So it's beautiful to see.
Absolutely. And now, Steve, I'll add one quick further point to that real quick. Kervin's exactly right. And, even for the introductions that, we've made for one another, still talk to folks from, potential sponsors he's introduced. I know some of the folks I'm introduced to him. And even on top of that, Kervin, your business partner is an old colleague of mine as well from my first shop, in the business from that firm, Centerline. So
Yep.
I think it lends itself to say that, good people in this business definitely tend to stick together. And I think, again, Steve, to your earlier point of, just how small of a business it is as well.
Exactly, because the crazy thing is, like Kervin's other business partner at the time was a client of mine when I was back at the resident group in the early 2000s. So when he told me that he kind of connected with her and she's a partner, in the historic tax credit space, I was like, this is really crazy. So it's a really, really tight space. One of the things that we do this podcast, Chad, to give folks who are aspiring to be, developers or getting to the business, a little insight from developers and professionals. From your aspect, and I know you deal a lot with sponsors, so you're on top of the whole underwriting. What do you see as the challenges to some of the smaller folks who are trying to get into business? I mean, obviously, we know that sometimes they'll have to joint venture with a larger firm to overcome those challenges. But you sitting on the debt side, what do you see that the challenges are for folks who are trying to break in?
Yeah, no, absolutely, man. I mean, listen, I think it's, the main hot topic that has been for some time, and I think will always, well, not, I mean, look, we hope it's not always, but I think that will persist for some time, is always access to capital, right? When you look at, sponsors who have been successful in this business, typically they have, if we're talking about on the development side, right, they typically have acquired a development site at a great basis. And what do you need to do in order to acquire that development site at a great basis, right? Typically, you've bought the land all cash, or you may have some low levered financing on it. But the bottom line is that you had access to that capital, whether it be debt or equity, in order to, act quickly and act appropriately, right? There's one thing to be able to, buy, whether it's land or, even an existing building, but it's having the capital that is not only available to you, but also accretive to the business overall. Right. And what do I mean by that is that it's not, overly expensive capital or capital that's not flexible and doesn't allow you to be nimble in the business, right? And that's the development front end. Even on the acquisition standpoint, it's the same thing, right? If you're going to buy an existing building, typically you're getting some type of loan from someone like me who's going to do, the first mortgage, the senior debt, right? And then you've got to come to the table with equity. Particularly for sponsors of color, it's, having the equity to be able to write that check, right? So, or having access to good partners who will be able to help you write that check. And oftentimes, those same sponsors who lack that access to, that capital and flexible capital, they also, need someone who's going to be able to sign on the loan guarantees, right? Because we have net worth and liquidity requirements for our deals. So I think it's the intersection of those two things, which I think has been the most prohibitive, historically speaking.
Got it. And, what people realize, a lot of folks, know what we're talking about when we refer to agency loans. For those that don't, we're really talking about multifamily buildings that are being financed with low-income housing tax credits. And, obviously, we've got the 9% ones that are competitive, and the 4%, which are tied into taxes and bonds. Your job is that you handle both sides. There's debt for both of those type of products. When someone comes to you, how do you kind of guide them through? You might be better off doing a HUD loan or a Fannie product or a Freddie product. How do you get them to that point on what's the right product for them?
Yeah, I mean, look, I think it's really about understanding, what you're looking to get out of the deal in the transaction, right? Are you looking to get a deal done that's going to be developed? You're going to sell that development? Typically, that isn't the case, right? With affordable housing. And I always like to open it up too, because the agencies, and when we refer to the agencies, to your point, Steve, we're referring to, Fannie and Freddie and HUD, are really pushing what we call mission-driven business, right? And that's where the rents at these properties are, at 80% of the area median income or less, right? We know traditionally an affordable project typically has what's called a set aside, or units that are set aside, right? Typically it's been 40% of the project at 60% AMI less, or 20% at 50, et cetera. And now we're pushing up to 80. Looking at the deal, like I said, if this sponsor is looking for, the highest possible leverage they can get, then yeah, maybe it's one of our forward agency products, right? That'll potentially underwrite to leverage up to 90% with a lower debt cover. But what you have today, where interest rates have gone, typically you're not getting to that, that higher leverage. In addition to that, you have the HUD product, right? Which is oftentimes a longer term, but also in some instances allows you to get a longer amortization than Fannie or Freddie. Now, Fannie and Freddie has been open to looking at longer amortizations, but with the HUD product, it's typically programmatic, right? If you build a deal with what's called the HUD 221D4, it's what I tell you, it's a 42-year term essentially, right? A construction period with a permanent term. And so, you also have a 40-year amortization with that. And what does that mean? That just simply means that, the payment you got to make on the loan is going to be lower than if you had a, call it a 35 or a 30-year, or even, in some instances, a 25-year amortization, right? And that all goes to benefit your bottom line when you're underwriting the deal, because again, back to what you want to get out of it, it also depends on your capital partners, right? What type of returns do you need to deliver to them? Is this a deal, like I said, that you're going to hold, for the next 15 years through a compliance period? Or is it a workforce deal that you bought and, you need to exit the deal in 5 to 7 years? So I think it's really understanding, the return profile and what you have to accomplish with the deal, which then will dictate what products that we look at.
And the time to close, Chad?
Yeah, time to close is definitely important as well. You know, Fannie Freddie deals. I mean, we like to say, you know, a standard kind of 45 to 60-day close. You know, HUD deals typically take a little longer to close, right? If it's, you know, development deal, you could be looking at, you know, a 12 plus month timeline, 12 to 15 months. If it's a refinance scenario, you know, you may be in that 4 to 6 month range. Um, yeah, and to your point, your point, Kervin, I mean, it just really again kind of depends on that business plan and how you need to execute.
Have you guys made any changes because of the current environment to how you're looking at the market and looking at borrowers?
Look, man, we're obviously doing our best. I mean, right now with the current environment, I think, you know, a lot of the deals are being driven by, again, kind of those metrics I mentioned, right? Deals that have what we call higher affordability, right? Not necessarily that they're, you know, a LIHTC or tax credit project, right? It could be a project that has, you know, rental restrictions with a project-based HAP contract, or, you know, a sponsor could be coming in to, you know, buy a workforce market rate project, and they're going to take it, you know, into a deeper affordable scenario where, you know, they're going to look for some type of tax abatement, et cetera, to basically, you know, increase the returns on the deal. So, you know, we are out pushing for best terms for sponsors. And I mean, listen, I'm working on a deal right now where they've got some, you know, voucher tenants at the property. And we're trying to get a 35-year amortization versus a typical 30-year amortization for a workforce deal. Right. So, you know, we're pushing where we can. We're trying to, you know, get longer interest only when deals are coming in at lower leverage. And, you know, for those forward committed loans that we're doing, what that means is, you know, someone goes out, they get an allocation of credits, and they're going to build a LIHTC project. You know, we have a forward commitment loan product that will essentially lock simultaneously with your construction loan. So, you know, trying to be nimble where we can there too. Like I said, pushing for that longer amortization, et cetera. Yeah, but I mean, in today's climate, man, it's really just about being, you know, prudent and underwriting, and you know, trying to push where we can.
Do you see any changes in the liquidity requirement at all? How much people have to come to the table?
I mean, for the most part, it has been status quo. You know, we are trying to, you know, mitigate, I'll say, where someone may have a slight shortfall. We're trying to, you know, mitigate that with structuring the deal. You know, but as far as kind of, I guess, for lack of better words, what's in black and white in the guide, right, has not changed. But, you know, we are trying to be helpful where we can. I mean, look, you know, Steve and I were talking about another project that we're working on where, you know, our sponsor was working on having, you know, the potential tax credit equity partner sign on a deal. And I mean, listen, they, you know, that sponsor didn't meet the typical requirements, but, you know, we were trying to be, you know, helpful in the sense of saying, hey, you know, kind of given the experience level here that they've successfully executed on some projects that, you know, maybe we'd be willing to lean in, right, on a construction loan that was kind of, you know, it was in our footprint. The sponsor was in our footprint, right, as a bank. While we didn't have a tax credit equity need in that particular market, because it was in footprint, we were, you know, trying to be reasonable and be open to say, look, if you elect to take this, you know, forward committed product with our construction loan, and we know that we don't have an open-ended construction loan, with some of the other things that went along with the deal, right? Like there was a developer opportunity fund that was going to help with some liquidity shortfall during the construction period, et cetera. Like I said, the tax credit investor was going to look to sign on the deal. So, you know, we were willing to say, hey, yeah, you know, we will kind of stretch a little bit here for construction, and in an effort to help capitalize the transaction. So it's really Kermit kind of, I guess in summary and in short, there's no programmatic or, here is the box that we have said, yeah, this is where we're going to kind of change our requirements. It's really just kind of taking a holistic approach and looking at every deal on a one-off basis to say, hey, let's kind of sit down and be thoughtful about this and really kind of understand demand drivers in the market, et cetera. And, do we think this is a viable project if we're going to lean in a little bit?
Okay, sounds good. I know you've been through a number of cycles before in the industry. Do you see developers maybe looking at secondary market, tertiary markets, given the current environment to just sustain their business? What changes are you seeing, or you expect to, or that you've seen in the past?
Yeah, yeah. Well, I mean, look, this really kind of first cycle, right? I mean, we had a very long expansion with this last cycle, right? Call it from kind of the downturn from, 08, 09. And I got in the business in 2011. And I mean, what I can say is, having seen it really kind of come full circle, yes, I will tell you that I'm seeing developers, owner operators, acquisition guys, et cetera, change their business plan. One, to your point, yes, absolutely. I've seen sponsors that have, moved into secondary, tertiary markets, right, where they, see value. I was just talking to somebody about a deal in Greer, South Carolina, the other day, right? And markets that historically have not, come up. And, you've seen the emergence of, other markets kind of move to the forefront between, Nashville and Tennessee and obviously the Carolinas have, gotten a lot of attention of late. And, obviously Texas and Florida has been there, but what I remind people of too a lot is that, as hot as Florida is and, people focus on it, I came here to Florida in 2014, right? Prior to that, the agencies had not, allowed us to extend credit on a programmatic basis over 65% leverage, right? Because of the historical kind of boom and bust in Florida. So, that's recent, right? Like 8, 9 years ago, when you think about how long, we've been in this business and folks have been doing business. So even oftentimes I have to remind people that, you have a lot of projects in Florida that are, just going to start to cycle because, kind of the requirements and lending levels change for Florida. And then to your other point, I mean, yeah, with developers, I mean, I think it's about, costs, right? Land costs have, been driven up in a lot of markets. I mean, especially we've seen it here in Florida, but even others throughout the country. So it really kind of, comes to a point of where you have to say, okay, what does replacement costs look like? Um, does it make more sense to acquire an existing asset versus develop? And then I think on the opposite spectrum of that, and kind of something that we see a lot and have to advise sponsors on is that as borrowers are chasing yield, oftentimes what that means as well is that you got to look for older product. Right. So you have sponsors that are chasing, 70s, 60s vintage product because I think, kind of 80s and early 90s have been the focus a little bit more, but, 90s didn't need as much and it was still kind of expensive for some time. So when you're chasing 60 and 70s, vintage product, typically you're going to have very large CapEx budgets, right? We're talking north of 20, 25,000, a door. So, sponsors are having to make a business decision to say, is it worth, chasing that product? Or yes, do I just go look at, listen, is it applying to an RFP or is it just, finding a site and chasing competitive credits and 9%? Or, do we just kind of by right take 4% and see how we can make a deal work by getting, other incentives from the, state or local municipality, et cetera. So yeah, I think there's a lot more thought and underwriting that has to go into business plans and deals today, right, to be sound. And I think that will continue for a little bit, right? As we navigate the volatility in the market.
I know curbing net worth and liquidity requirements, and I know that kind of varies on a deal-to-deal basis, but it's a common question that we get from folks who are trying to really break in. Is there a rule of thumb for net worth and liquidity? I know it's case by case, but is there like a generality that you can apply when you're looking at sponsors?
Yeah, I mean, look, the general rule of thumb, right, is typically you want a net worth equal to the loan amount and a post-closing liquidity, right? So not assuming that they're going to cash out on some other deal and add it like kind of post-closing liquidity of 10%. Um, so net worth equal to the loan amount, post closing 10%. I mean, listen, there are some exceptions, right? I mean, we have instances where you have, nonprofits who are in the business of operating and owning real estate and have great track records. And, everyone here, I think, knows that typically nonprofits operate at some slim margins sometimes and slim budgets. So they may not meet that function. And then that's where, sometimes we've seen a tax credit investor sign on a deal as well, or they've had a decent net worth and liquidity, and it may not be equivalent to the loan or hit those metrics, and where we have to kind of file and look for some type of exception. But that said, I mean, while we want to try to be helpful, I mean, we do look for I would say a net worth and liquidity relative to the deal, and that kind of aligns with either their overall portfolio and leverage, right? Like we try to make the case holistically if they don't meet those exact requirements.
Chad, you mentioned the 1960s, 1970s product. Do you see a lot of developers now looking at like historic tax credits and energy tax credits to support their capital stack?
To be honest with you, Kirby, I don't play a lot in the historic energy tax credit space. I do know that sponsors are looking for those alternatives to fill the gap. Funny enough, I was actually looking at a project here in Fort Myers, and they were looking at historics on the project because there was some a retail component, and it was a historic building, like I think a mill or something along those lines, and they wanted to kind of preserve the facade and the building itself, and then attach some multi to it on the side. So I do know that sponsors are seeking those additional dollars, and I mean, listen, we've seen the emergence of the PACE financing and the ground lease world. I mean, what I would tell your listeners is that on a relative basis, a lot of aside from the historic tax credits, right, like kind of the PACE and the ground REIT stuff and things like that are just a little bit newer to the front. So don't be frustrated when lenders kind of either dismiss projects, because those I know they look like good avenues to help capitalize deals, and I think in some instances they are. And I think as it just becomes more prevalent, I think we'll start to see it become a little more constant in deals.
You made a good point about CPACE. I was almost not going to really talk about it, but there is a little confusion that I was actually trying to clear up. So this is relevant. Like from what I understand, like HUD products won't use CPACE. I believe Fannie may not. I understand Freddie can, but they either need regulations or regulations are being drafted. But you got like a Naveen out there who's got billions of dollars of capital, ready to deploy for CPACE. What are your thoughts on CPACE? And am I accurate that HUD doesn't use it, Fannie doesn't use it, but Freddie may?
I think you're pretty spot on, Steve. Well, I have heard that HUD has done a handful of deals, and when I say handful, I'm literally referring to counting on one hand. And I think that number has slightly grown. So I think they have. You're right. Fannie has not looked at PACE to my knowledge at this standpoint. And yes, Freddie does have some guidance around it. But again, I just like I mentioned, I think it's always about adoption speed, right? So yeah, Freddie, as far as I know, has not closed anything with PACE. And listen, I think it's a bigger front, right? I know sponsors oftentimes get frustrated because we've looked at some pay stuff, and to my knowledge, I they were not my deals. I have not done them, but I do know that M&T has done some loans where Pace has been in the senior stack on the construction standpoint. But what I will tell you, what you're saying, and I think you'll hear this from the Pace folks as well too, is that what you're seeing is that senior leverage is coming down when the Pace is coming in, and or Pace can kind of be used to sell down effectively on the deals because of the fact when we do have to look to refi because the agencies haven't become widely adopters of it yet. You've got to get that Pace out of there, right? And listen, this is no talking points from M&T, nothing from them. I mean, kind of my own thoughts around it, right? Is because we're talking about a big animal, right? And when I say a big animal, we're talking about two groups, Fannie and Freddie, that are doing 70+ billion a year in financing with a model that's kind of been tried and true, proven and tested, right? With securitization, Freddie has his K series, Fannie securitizes deals one off that are sold. So when you start talking about something like a Pace that doesn't, for lack of better words, doesn't necessarily sit in front of the senior, but it is being paid because it comes in like an assessment on the tax bill, right? Like there's a lot of regulation around that. And, like I said, you have structuring with the securitizations. There's probably ways it needs to be reported. So I think it's really going to take some time for the adaptation of it to the marketplace. So I would just tell people to continue to get smart about it, and build a knowledge base around it, because I do think eventually it will become more widely used.
Got it. And then one last question from me, and I know Kervin has one more. In the industry itself, both it's not probably particular to affordable, but we're seeing a lot of programs prop up for Black and brown developers. I'm seeing it on the developer side where shops like Enterprise will come in and they want to be a co-developer for an upstart Black or brown firm. We just did a podcast with NEF, and they have a program as well where they'll backstop a guarantee. Do you see any of that going on with some of the debt there in terms of programs targeted for Black and brown developers?
Yeah, man, definitely seeing folks make strides. Like I said, what we're doing, looking at deals, we're trying to do the same as well too. I have friends who have gone out and they kind of already had their own shops where they've raised funds, and they've been able to partner with some big names in the industry, and or kind of family offices that have said, hey, look, we want to be impactful in a way that'll help you grow your business. And what is that, right? We need I use the pun since we've had gas shortages here in Florida, right? They need the gasoline behind them. Really, right? They've kind of built out the business. They've worked for, some of the most reputable names in the industry, right? When you're talking about, large acquisitions, EQR and BlackRocks and Blackstone's World, et cetera. And so now they've kind of gone on and launched these platforms. So we are seeing some movement in that arena. It seems like, every now and then I'm seeing someone who's joined kind of an impact capital, either lending or equity shop. And look, I think like anything else, again, it takes a very long time, to put these things together, to develop a business plan, to allocate the dollars, to create an execution around it. Because at the end of the day, it's still about ROE, right? It's return on what the equity is. So, look, I would love to see us farther along in the space. I think we're making good strides. I think it will continue to move, and I think folks like the real estate shop and, what you and Kerwin are doing are, being the beacons of light that have to continue to put a spotlight where there is room for improvement. Right. And there is the ability to not only invest in, BIPOC, minority, to throw some other acronyms out there, but invest in people, who may not fit the typical status quo of being a portfolio manager or allocator or asset manager and or developer, sponsor, acquisition group. I'm trying to kind of capture everything here. But we're seeing it. We're seeing them emerge, and I think we just have to continue to make sure the conversation stays at the forefront, and that it doesn't become something that just kind of becomes okay, the norm, or hey, we tried and we were not successful, because we do know that real estate is a slow business and it takes time.
Got it. So, Kerwin, take it home, man. Appreciate it, Chad. Always good talking to you. I think Kerwin's going to wrap us up.
Yeah, for sure. Chad, I think this has been really, really informative. Any last comments about where you think the market's going to go given the current conditions, or any advice you have for borrowers that are looking for capital right now?
Yeah, I mean, look, the big thing that I will always say is, look, if you got a deal and the numbers work for you, close your deal. Because if one thing recent times haven't shown you is that, we don't know what can happen, right? I mean, yeah, the interest rate volatility is going to continue to persist in the market for a little bit. I mean, listen, look, I wish I had the crystal ball, and candidly, I probably wouldn't be sitting here talking to you. We might be doing this interview on my boat because I would know everything that was going to happen, and I probably would have picked the Mega Millions with the mega plier long ago. But listen, close your deal if you got a deal that's in front of you. Yes, rates are up. Historically, rates are not at a level that is crazy. More seasoned, older developers will tell you, hey, I was doing deals, when rates were 8, 9, 10%. Right. So while I understand that, cost of living is higher now, cost to build is higher now, et cetera. Listen, we can figure out how to make this work, and, understand that lenders and other folks, we're reactionary, right? We have to react to the market and where it is in order to ensure that, we don't create the issues that do come with quantitative easing, right? And cheap capital. I think everyone got accustomed to, much lower rates and spreads. And listen, I think some headwinds that we're going to face as, many properties come up for refinance, recapitalization, and there's going to be some shortfalls there. Anytime you have rates that, have risen, 300-400 basis points, it's going to be challenging, right? I was talking to somebody, funny enough, about this, the other day. I started with M&T last July, and, rates, I think, kind of on an agency front, especially in the affordable housing space, are probably overall 85 to 90 bips, kind of for your typical kind of fixed capital markets, 7-10 year deal, right? If you're just acquiring a deal in an extended use period or something like that and just getting your standard, 7 or 10 year loan. But that said, on the, kind of structured arm and adjustable rate mortgage front, rates are up, 400 basis points. We were doing 7-year ARM deals at 3.25. Today those same deals are pricing, 7.25 and or higher, right? So yeah, rates are up, and we know what that means for values. They're going to need to come in as cap rates expand. But bottom line, if you got an execution that works and it hits your deals and everyone's happy, close your deal, because you don't want to be the guy that's, sitting next to me saying, oh man, well, the next guy closed and, he got a rate 50 bits cheaper than me, then you wait 2 days later and you could have closed at X, and now you close at a rate that is, 50 bips wider, because there was some swing in the marketplace. So, I think we're going to face, in short, I think we're going to continue to face some headwinds with interest rate volatility. I'm hoping that it will settle here soon, but obviously we got to wait for the data to come out from the Fed and, other smart folks that are doing a lot of modeling. And I think once we have that, I do expect kind of the volume and velocity of business to pick up, right? I mean, kind of the consensus that I've heard is that it's going to be on the, back half of the year and third and fourth quarter that they expect to see the acquisition market open up a little bit, which I think in turn will, make way for everything else, right? Less competition of folks who's trying to pivot to development, to chase yield, et cetera. So, listen, the bottom line is we've always gotten through it. We'll get through it. We just got to stay the course. And we know that, underwriting has been more sound this time around, but there still remains to be, some distress when you've got rates that are, like I said, up, 400 plus basis points. So remains to be seen, but I think everyone should just stay positive.
Another day at the shop, content they can't get anywhere else.